Q2 2026 Choice Properties REIT earnings just crossed the wire. Looking at a quarter that definitely met underlying business expectations and management maintained full-year guidance. But man, they threw a massive curveball on the bottom line.
No, absolutely. It's quite a report.
Yeah, so let's hit the headline numbers immediately. Rental revenue came in at $361.3 million. That's up 3% year over year.
Solid growth.
And FFO, so funds from operations per unit on a diluted basis, ticked up slightly to 0.267, which is a 0.8% increase year over year.
Right.
But on a GAAP basis, the company reported a staggering net loss of $176.4 million.
Yeah, that's the number turning heads today.
Totally. Now, looking ahead, full year 2026 guidance is firmly maintained. They're targeting 2 to 3% same asset net operating income growth on a cash basis, an annual FFO per unit diluted of 1.08 to 1.1 DAL, and adjusted debt to EBITDA below 7.5 times.
Which is very steady.
Right. And following the report, the market actually completely shrugged off that massive GAAP net loss. The unit price closed the quarter higher at $16.34.
Which is fascinating, right?
Right.
Seeing a stock tick upward on the same day it prints a 9-figure net loss is, well, it's the ultimate filter for separating the headline skimmers from the people actually reading the financial statement.
Seriously.
Because anyone running a basic stock screen for GAAP profitability or like traditional PE ratios is going to look at Choice Properties today and think the business is just imploding.
Oh, for sure.
But the market reaction proved that institutional capital sees an entirely different, much healthier engine running under the hood.
Okay, let's unpack this. Because if you are a retail investor checking your portfolio on your lunch break and you see your safest, most boring, grocery-anchored REIT just posted a $176.4 million quarterly loss, panic is just a natural response.
Of course it is.
It triggers that primal urge to liquidate the position. So we need to dissect this accounting anomaly right out of the gate. Because clearly actual cash isn't vaporizing from their bank accounts.
No,
Oh.
no, not at all. The cash is perfectly safe. What we are looking at is a pristine example of a paper loss. It's driven by a very specific, almost counterintuitive quirk in GAAP accounting rules.
Okay, so how does that work?
Well, it all comes down to how Choice Properties is required to value their exchangeable units. Like a lot of major real estate investment trusts, Choice have a class of units that can be exchanged for standard trust units at the holder's discretion. And because of that exchange feature, accounting rules dictate that these units cannot be classified as standard equity. They actually have to be classified as a liability on the balance sheet.
And because it's a liability tied to the stock price, it creates this moving target every single quarter.
Exactly, a target that they are legally required to mark to market. So at the end of every quarter, the accountants have to look at the current trading price of Choice Properties stock and recalculate what it would theoretically cost to settle all those exchangeable units at that exact moment.
So to map the actual mechanics of this, because the stock price went up during the second quarter, which obviously indicates the market liked the underlying operational performance.
Right.
The theoretical cost to settle that liability also went up.
Yes. And that increased liability doesn't just sit quietly on the balance sheet. The change in value has to be recorded as a fair value adjustment, and that adjustment flows straight through the income statement as non-cash expense.
Wow.
Yeah, the brutal irony of this accounting standard is that the better the actual stock performs during a 3-month window, the worse the GAAP net income looks. I mean, to put this in perspective, they reported a $154.2 million net loss in the prior year period for the exact same structural reason.
It's essentially the corporate equivalent of being a short seller of your own stock.
That's a great way to put it.
Right. Like when your company's market value goes up, your paper liabilities skyrocket and you take a massive hit on the income statement, even while the physical grocery stores and warehouses are just sitting there collecting rent checks without a single hiccup.
It perfectly illustrates why serious real estate investors completely ignore GAAP net income. When accounting rules force you to penalize your current earnings based on the perceived market value of your capital structure, the actual performance of the real estate gets completely buried in paper noise. To measure the true health of a REIT, you have to strip all of that away and focus on the ground-level cash generation, which, leads us directly to their Same asset net operating income, or NOI.
which is the purest metric for organic growth.
Exactly.
Because same asset NOI ignores any properties they bought, sold, or built during the quarter. It just isolates the existing portfolio and asks, how much more cash did these specific buildings generate this year compared to the same 3 months last year?
Right.
Overall, same asset NOI on a cash basis increased 2.8% to $255.4 million. But the segment breakdown is where the narrative gets a little messy.
It does.
Industrial properties led the charge, up 5.8%. Mixed use and residential was up 4.1%. But retail, which is the core of their entire empire, lagged behind, up only 1.9%.
Yeah, that 1.9% figure is definitely the glaring outlier on the page, especially considering retail isn't just a side project for them, it is the absolute foundation of their portfolio.
Hold on, let's dissect that, because praising their retail strategy feels contradictory to those numbers. Choice Properties is famous for their heavy concentration with Loblaw.
Right.
Loblaw alone makes up 57% of their total tenancy. So if their massive retail portfolio is only growing at a measly 1.9% while their industrial sheds are printing nearly 6% growth, doesn't that suggest their grocery concentration is actually like an anchor dragging down their overall potential?
Well, if you stop at the top line segment summary, that is the most logical conclusion you could draw. But the footnotes in this earnings release tell a completely different story.
Oh, really?
Yeah. That 1.9% retail same asset NOI figure is artificially depressed by a bad debt expense from a single tenant bankruptcy that hit in the current quarter.
I see.
Right. A bad debt provision forces them to recognize the lost revenue all at once. If you normalize the data and strip out that specific one-off hit, the underlying retail same asset NOI actually increased by 2.4%.
Oh, okay. So it isn't a structural ceiling on their ability to raise rents. It was just a localized casualty in the portfolio that dragged the quarterly average down.
Far from hitting a ceiling, their underlying rent growth is exhibiting incredible strength. Which brings us to the reality of the Loblaw relationship. It isn't an anchor, it is a gravitational force. In the management commentary, CEO Rail Diamond specifically highlighted, quote, robust leasing spreads. When you look across their portfolio, their long-term renewal spreads are sitting at a massive 19%.
19%. Let's pause and think about what that means for a physical business. When a long-term commercial lease expires, the tenant is agreeing to sign a new contract with a rent hike of nearly 1/5.
Yep.
A retailer doesn't accept a 19% increase unless their sales per square foot at that specific location are so strong that they literally cannot afford to move anywhere else.
They accept it because they know exactly where the foot traffic comes from.
Well,
Choice Properties has built a portfolio that is 83% necessity-based retail.
right?
When your primary anchor tenant is Canada's largest grocer, you are offering a physical location that is basically immune to economic cycles. People are going to buy groceries whether interest rates are at 2% or 8%.
Totally.
That guaranteed high-frequency foot traffic makes the smaller inline retail spaces, the pharmacies, the banks, the quick-service restaurants, incredibly lucrative.
It's the classic solar system model. The Loblaw grocery store is the sun, generating all the heat and gravity, and the smaller retailers are the planets orbiting it, perfectly willing to pay a massive premium to stay in the warm zone.
A premium that translates directly into that 19% renewal spread. Management utilizes the stability of the anchor to ruthlessly optimize the pricing of the ancillary spaces. So the Loblaw tenancy isn't capping their growth. It is the fundamental leverage that allows them to push rents aggressively across the rest of the ecosystem.
Strong leasing spreads are the dream scenario for long-term property valuations. But if you are holding a retail REIT in your portfolio, your most immediate concern is the safety of the dividend. You want to know exactly how efficiently all that operating income translates into distributable cash.
Absolutely.
And when we look at the cash flow mechanics for this quarter, there is a metric that might induce a bit of anxiety.
The drop in AFO.
Adjusted funds from operations, yes. AFO per unit diluted dropped 6.1% year over year, down to 0.217. We literally just spent 5 minutes establishing that rent collections are healthy and renewal spreads are hitting 19%, so seeing a 6.1% decline in the actual cash available to pay dividends feels like a massive contradiction.
It does, but it requires looking at the specific mechanics of how AFO is calculated compared to standard FFO.
Okay, break that down.
We noted earlier that FFO actually increased slightly. FFO represents the pure cash generated by operations. AFO takes that number and deducts the very real cost required to keep the properties competitive, specifically maintenance capital expenditures and tenant improvements.
Right.
The 6.1% drop this quarter wasn't caused by shrinking revenue. It was driven entirely by the timing of those capital spends.
So, rather than looking at it like a homeowner fixing a leaky roof, let's look at it from a commercial leasing perspective. This is like a landlord ripping out outdated HVAC systems and completely reconfiguring the floor plans of an aging plaza just to secure a new premium 10-year anchor lease.
Precisely.
Your cash flow for that specific quarter takes a beating because the cash is flying out the door, but the actual revenue-generating capacity of the asset hasn't structurally declined. It's capital deployment designed to lock in future yield.
That is the exact mechanism at play. They deployed more capital into leasing and maintenance during Q2 2026 than they did in the same period last year. It is a direct investment in sustaining those 19% renewal spreads. You cannot demand top-tier rent hikes from commercial tenants if you allow the physical property to slowly degrade.
Yeah.
The cash generation engine is completely intact. They just chose to reinvest a larger portion of it back into the hardware this quarter.
Okay, so if the AFO drop is purely a timing issue regarding capital deployment, the next logical step is stress testing the dividend itself. They declared a distribution of $0.195 per unit this quarter.
And the distribution remains highly insulated. We measure that safety using payout ratios. Their FFO payout ratio is sitting at a very healthy 73.2%.
Wow, that is healthy.
Yeah, and even factoring in the elevated capital spend that dragged down the AFFO, their AFFO payout ratio is 89.9%. As long as that AFFO payout ratio remains under 100%, the REIT is generating more free cash than it is distributing to unitholders. Operating at 89.9% provides a really solid buffer.
But the safety of a dividend in modern real estate doesn't just rely on cash flow, right? It relies on how a company manages its liabilities. In a high interest rate environment, a REIT's debt profile can destroy a great property portfolio overnight. We really need to dissect the balance sheet.
We do, and Choice Properties has spent years constructing what analysts refer to as a fortress balance sheet.
Oh, absolutely.
The key metric management focuses on is their adjusted debt to EBITDA-V. For anyone who doesn't spend their life building real estate financial models, EBITDA-V stands for earnings before interest, taxes, depreciation, amortization, and fair value.
Basically all the paper noise stripped out.
Exactly. It's essentially a standardized way to measure their total debt against their core cash flow. That ratio is currently sitting at 7.0 times.
Which is incredibly disciplined, especially considering their internal target ceiling is 7.5 times.
And it becomes even more impressive when you consider they aren't just hoarding cash, they're actively deploying capital. During the quarter, they advanced $44.3 million in construction loans for the Choice Caledon Business Park.
Oh, wow.
Yeah, they're effectively acting as a lender to fund new industrial development, diversifying their exposure away from pure retail while still keeping their overall corporate leverage well below their own strict limits.
And when you look at their overall asset base, the adjusted debt to total assets ratio is a very conservative 40.4%. But the metric that truly defines their financial security is the unencumbered asset pool. They are currently sitting on $14.1 billion in unencumbered assets.
That number represents the ultimate liquidity backstop.
We need to make sure the gravity of that $14.1 billion is clear. Unencumbered assets are properties that the REIT owns free and clear. There are no property-level mortgages tied to them. In a scenario where global credit markets freeze up, which, we have seen happen multiple times in the last 2 decades, having $14.1 billion of pristine, necessity-based real estate without a single bank land on it provides an almost unfair level of financial flexibility.
It really does.
If traditional unsecured borrowing dries up, they have a massive pile of collateral they could immediately borrow against.
It allows management to sleep very well at night. Furthermore, the debt they do carry is structurally insulated from short-term interest rate shocks. Their weighted average interest rate across the portfolio is locked in at 4.29%.
Which is fantastic right now.
Even more crucially, they have a weighted average term to maturity of 6.1 years.
The term to maturity is arguably more important than the rate itself.
Oh, without a doubt.
Because the nightmare scenario for a highly leveraged real estate company is hitting a quote-unquote debt wall. Having massive chunks of low-interest debt maturing all at once, forcing them to refinance at today's potentially brutal market rates.
But Choice Properties doesn't have a debt wall. By pushing their average maturity out past 6 years, they have bought themselves an enormous runway. They are paying just over 4% on their capital while generating 19% renewal spreads on the real estate bought with that capital.
Incredible.
It is a highly predictable, low-cost structure that completely underpins the safety of their dividend.
It paints a very clear picture of a management team playing a conservative, multi-decade game. The immediate cash flow is guarded by grocery anchors, and the balance sheet is locked down tight. But you don't build a fortress balance sheet just to admire it, you build it to fund future expansion. Which brings us to the forward-looking strategy.
Their pipeline is staggering. Management is actively navigating a development pipeline that exceeds 18 million square feet of future space.
18 million square feet is like a small city.
It is. And the strategy for unlocking that space is what makes this REIT so unique. They've identified over 70 specific sites within their existing portfolio that are primed for incremental density. They aren't venturing out to the suburbs to buy raw land. They're looking at the assets they already own in major urban centers, specifically single-story grocery stores surrounded by massive, sprawling surface parking lots. And they are strategizing how to build vertically.
Which introduces one of the most fascinating details buried in this earnings report. They highlighted a specific community initiative called Lots of Play, located in Toronto's Leslieville neighborhood.
Yeah, this was so interesting.
Right. They partnered with an arts organization called Vive Arts to take a standard asphalt parking lot and temporarily transform it into a vibrant 3-day community hub featuring live performances, workshops, and local engagement. So here's where it gets really interesting.
Okay.
Are we looking at standard corporate ESG marketing, or is this a highly calculated chess move to secure grassroots buy-in before they attempt to rezone that specific urban site for massive, high-density residential towers?
It is absolutely a calculated vanguard for future development.
Yeah.
The reality of modern urban real estate is that local zoning boards and city councils are heavily influenced by neighborhood sentiment.
Oh, heavily.
If a massive REIT walks into a tightly knit community like Leslieville and files paperwork to bulldoze a local grocery store parking lot and erect a 30-story condominium tower, the neighborhood will mobilize. The classic not-in-my-backyard friction will tie the project up in bureaucratic litigation for years.
It just becomes a war of attrition between the developer and the neighborhood association.
But if you lead with placemaking, if you activate that dead asphalt and turn it into a community asset where families gather, you slowly change the narrative. You prove to the community that you are invested in the social fabric of the neighborhood. By the time the actual development proposal is submitted, a proposal that likely features a modernized grocery store at the pedestrian level with high-density residential units stacked above, the community views the REIT as a collaborative partner rather than an invading force.
That's brilliant.
It is an incredibly sophisticated method for streamlining the rezoning process across those 70-plus targeted sites.
A masterclass in urban diplomacy disguised as a weekend block party. But while the long-term densification strategy is brilliant, management's forward-looking commentary also included a very specific warning flag for analysts trying to model the near-term future.
Yes, the pending transaction involving First Capital REIT, or FCR, and KingSett. The forward-looking statements in this report were remarkably blunt regarding this deal.
How so?
Management explicitly stated that they can neither predict the final timing of the transaction closing, nor can they accurately predict the ultimate financial impact it will have on their balance sheet.
When a management team that prides itself on predictability admits they have a blind spot, it forces the market to price in a discount.
Exactly.
To understand why it's unpredictable, we really have to look at the nature of these massive institutional transactions. Deals involving players like FCR and KingSett rarely involve just writing a simple check. They often involve complex asset swaps, the unwinding of historical joint ventures, or, intricate portfolio restructuring. Until the ink is dry and the final valuations of the specific assets changing hands are locked in, the exact impact on the balance sheet remains a moving target.
Which is exactly why Choice Properties explicitly noted that their 2026 guidance, the 2 to 3% fade now for Realty, same asset NOI growth, and the FFO targets we discussed earlier, completely excludes any potential impact from this pending transaction.
Good to know.
Institutional capital absolutely despises uncertainty. If an analyst cannot accurately model the capital outlay or the incoming asset yields in their discounted cash flow models, they will naturally apply a risk premium to the stock. Until this transaction officially closes and the numbers are integrated, It remains a tangible overhang on what is otherwise a highly stable quarterly report.
So, synthesizing everything we've covered today, we have a terrifying GAAP net loss that is actually just a phantom byproduct of mark-to-market accounting.
Yep.
We have a retail portfolio anchored by the largest grocer in the country, leveraging that foot traffic to extract 19% renewal spreads from ancillary tenants.
Well, yeah.
We have a highly secure dividend protected by $14.1 billion in unencumbered assets. And finally, we have an 18 million square foot development pipeline that is quietly using community arts festivals to set the stage for massive urban densification.
The headline numbers completely mask a highly defensive, cash-generating machine that is methodically laying the groundwork for its next decade of growth while managing the short-term noise of a complex institutional transaction.
Which leaves you, the listener, with a brilliant paradox to evaluate. It is highly likely you originally added choice properties to your portfolio, seeking a sleepy, ultra-stable yield, relying on that 57% Loblaw grocery tenancy as the ultimate defensive ballast.
Right.
But when you factor in the 18 million square feet of development potential, the ruthless 19% renewal spreads, and their sophisticated strategy for unlocking vertical density on urban parking lots, you have to ask yourself a fundamental question.
Mm-hmm.
Are you actually holding a stealth urban developer that is currently mispriced by the market as a boring grocery landlord?
It's a very compelling thesis, and it proves why relying on basic stock screeners and headline summaries is a dangerous game in commercial real estate.
Absolutely. So if you want to keep cutting through the gap noise and understanding the actual mechanics driving the most important companies in your portfolio, make sure you follow the show for our daily, no-nonsense earnings coverage. We'll be back tomorrow to unpack the next one.